Welcome to the Deep Dive, your shortcut to being genuinely well-informed. We take the sprawling, complex world of technology, finance, and geopolitics, and we distill it down.
Right down to the essential high-impact insights you actually need to know.
And today, we are wading into the deep end of the market frenzy.
Okay.
The question that is just dominating headlines, balance sheets, everything is singular. Are we witnessing the start of a durable, real technological revolution driven by artificial intelligence?
Or are we just standing at the precipice of a massive speculative bubble, one that really echoes the volatility of, 2 decades ago now?
Exactly. And our mission today is clear. We've analyzed a mountain of source material that explicitly compares the current AI investment frenzy with its, incredible multi-trillion-dollar valuations to the infamous dot-com boom of 1999 and 2000.
But we're not just looking at the macro comparisons. That's kind of the easy part.
Right.
We're going to explore the unique, very highly concentrated financial fragility that's emerging in a place you might not expect.
The physical infrastructure, the stuff that's supposed to power all this AI.
Precisely. And that entire conversation ultimately circles back to the most critical, the most scarce resource driving this whole ecosystem.
Compute power.
Compute power. We need to unpack the data to figure out exactly where all this optimism is grounded in, measurable productivity gains, which are undeniable, by the way.
Absolutely.
And where entirely new, distinct financial risks are forming that have the potential to destabilize the market.
Okay, let's unpack this. We have to start by laying the historical groundwork. If you look at the last great tech boom, the dot-com era, the core narrative was, it was identical to today.
It really was.
A foundational technology promising to remake everything. So why are so many experienced investors and analysts immediately drawing the bubble comparison?
Well, the comparison is just irresistible, isn't it? Because the psychological drivers are the same. You've got FOMO, the fear of missing out. You've got the belief that this time is different. And just the raw fear of being left behind by an exponential shift. But, and this is the important part, when we move past that narrative and look at the actual financial data, the story of the AI boom becomes significantly more nuanced.
And in some ways, less extreme than 2000.
In several key ways, yes.
Yes.
Less historically extreme.
That nuance is the key, because the underlying narrative, the idea that AI is transforming the economy, that's not a lie. It is happening.
It is, yeah.
The issue is market expectation. The market has bet that the technology's full potential will be realized in, 18 months, not 18 years.
Exactly. So to figure out if we're in a bubble, we have to see if those financial expectations are realistic relative to the fundamentals we can actually measure.
So where do we start? What's the clearest indicator?
The clearest quantitative indicator of speculative excess is valuation multiples, specifically the forward price-to-earnings ratio, or PE ratio.
Right, and that just tells you how much investors are willing to pay today for every dollar of expected future earnings. The peak of the dot-com bubble in March of 2000 was it was staggering. The PE ratio on the NASDAQ 100 index hit an astonishing 60 times.
60. Let that sink in. A PE of 60.
If you were paying $60 for every $1 of expected earnings, you weren't valuing the company on its present performance.
Not at all.
You were purely speculating on unbounded future growth that, frankly, might never materialize. It was euphoria translated into a financial metric.
Absolutely. And today, the landscape is, it's just much different. Looking at data from late 2023 and early 2024, the PE ratio for the NASDAQ 100 hovered closer to 26 times.
26.
Now, let's be very clear. 26 times is high. It's definitely above the long-term historical average.
Oh, for sure. It's not cheap.
But it is less than half of the dot-com extreme. That single data point is probably the most powerful argument against the idea that the entire index is suffering from the same generalized speculative mania we saw back in 2000.
And that difference, it really speaks to market psychology, doesn't it? In 2000, investors were willing to tolerate these absurd valuation gaps because the underlying technology, the internet, was new and mostly unproven in terms of actually making money.
Right. It was all potential.
Today, investors are still paying a premium, but that premium is grounded in something much more tangible.
Exactly.
Yeah.
Though we have to note, the nominal figures are historic. When we see a major player like Nvidia briefly surpassing a market cap of, 3.3 or even $4 trillion?
Unprecedented numbers.
They're figures we've never seen in corporate history. But the fundamental difference is that the multiples driving those valuations are lower, precisely because these firms are generating real, colossal profits right now.
They aren't vaporware.
They are not vaporware.
So if the overall index multiples are, let's say, relatively subdued compared to 2000, what happens when we drill down to the actual quality of the companies that are driving those multiples?
This is, for me, perhaps the strongest structural argument that differentiates today's AI boom from the dot-com bubble.
Profitability.
Profitability.
Yep.
In 2000, market sentiment was so forgiving that a widespread lack of profit was just standard. At the height of the bubble, only about 14% of dot-com companies were actually profitable.
Only 14%. Investors were funding ideas and traffic, not earnings.
They were funding clicks. That's it. Today, the firms commanding the top market caps, Apple, Microsoft, Google, and crucially, Nvidia, they're not just profitable. They are profit-generating machines operating at a global scale.
They have established business models, global reach. It gives them this enormous financial resilience that just didn't exist for the high flyers of 1999.
And look at Nvidia, right? The essential supplier for the entire AI ecosystem. They reported an astounding net margin of 53% in 2024.
53%? That's not just profitable.
No, that is pricing power, almost monopolistic pricing power. It shows they are capitalizing immediately and extremely effectively on the bottleneck they control.
And that massive margin, it acts as a kind of financial defense mechanism, right? It lets them reinvest heavily or just weather any market storms.
Perfectly put. But if we're doing a deep dive, we have to acknowledge the major caveat here.
Of course.
The source material highlights that the market is deeply segmented. So while the incumbents are wildly profitable,
many of the younger AI startups, particularly the ones focused on specialized generative AI applications, they still produce little or no revenue.
None. They are high-burn, high-speculation enterprises that are relying entirely on venture capital and a future promise.
So you've got this two-tiered system.
It's crucial. We have a profitable foundation, the incumbent tech giants and chip makers. And that foundation is funding an ecosystem of intensely speculative, revenue-lacking startups.
So the risk isn't necessarily at the top layer of the market.
Exactly. It's focused on the bottom half, where capital is being poured into ideas that have not yet proven they can capture external customer dollars. The system is, let's say, structurally sound at the top, but it's very fragile at the bottom.
And that fragility, that leads us directly into sentiment. This is where it gets really interesting for me. Unlike the, seemingly uniform, almost cult-like euphoric belief in the new internet economy in 1999, investor sentiment today is strangely sober, even skeptical.
It's a huge shift in market psychology. We have specific data from surveys that show persistent caution.
Like what?
Well, surveys of global fund managers conducted in late 2025 indicated that 54% of them,
more than half,
54% believed AI-related stocks were already in bubble territory.
Wait, think about that. A majority of professional money managers are explicitly warning that the area they're supposed to be investing in is overheated.
It's incredible.
So why are they still investing if they believe it's a bubble? This is the tension, right?
It is. It's the fear that the underlying technology's potential is so vast that even if they buy into a bubble, the subsequent correction will still leave them holding a stake in the truly transformative technology of our era.
So they're balancing valuation risk with technological obsolescence risk. You can't afford not to be in it.
Precisely. And this caution is reflected in warnings from the very leaders of the industry. We're seeing explicit urges for moderation.
Right. You've got Sam Altman from OpenAI who publicly said something like, people will overinvest and lose money.
Exactly. And Jeff Bezos, who saw the dot-com crash firsthand, he called the current environment kind of an industrial bubble. Executives from Intel, Alibaba, they've all echoed similar sentiments.
Urging caution against the frothiness.
Yes.
So if 54% of fund managers think it's a bubble and the CEOs are warning us, what does that imply?
It supports the view we mentioned earlier. The underlying narrative of AI transforming the economy is correct. That's the long-term value.
But the market has mispriced the speed of that transformation.
That's the key. The gains have been too fast, creating a gap between valuation and the fundamental growth trajectory. And that gap, that's the definition of a speculative environment that's ripe for a major correction.
Okay, another crucial distinction has to be the maturity and deployment of the tech itself, right?
Absolutely. In 2000, internet adoption was still relatively low. A lot of dot-com businesses were just selling concepts that lacked proven revenue streams.
Today, AI is already deeply embedded in the corporate operational fabric.
The numbers confirm this deep integration. Data from 2024 shows that somewhere between 70 and 78% of companies globally
70 to 78%.
reported using some form of AI, whether it's for automation, data analysis, security. Large global enterprises are deploying these models right now for concrete tasks.
So you're getting immediate revenue and productivity feedback loops that contrast sharply with the whole build it and they will come ethos of 2000.
That said,
Hmm.
despite the widespread deployment, the market concentration looks eerily familiar.
Ah, okay.
It was like in 1999 when a few NASDAQ stocks, Cisco, Intel, Microsoft dominated the market cap. Today's top AI and tech names command a record share. They make up about 40% of the S&P technology sector.
So the economic power is still extremely concentrated at the very top of the stack.
Very. And if we follow the capital, we see where the bubble-like behavior truly resides. The concentration of investment capital is staggering.
Okay, hit me with a number.
In early 2025, 58% of all global VC funding went to AI startups.
58%. Wow. That is a truly extraordinary skew. The investment world isn't just leaning into AI, it's stampeding.
It's a stampede. This highly concentrated deployment of billions suggests that capital is chasing the AI label, regardless of the underlying business plan or the profitability timeline.
It's narrative over fundamentals.
It's when more than half of all available venture capital globally is focused on one sector. It suggests an allocation that's driven by frenzy rather than measured risk assessment. This influx has been so intense that even CEOs of major infrastructure firms have explicitly called the surge of funding peak AI bubble.
Okay, so summarize part one. We have these profitable giants anchoring the market, which is less stretched than 2000. But we also have this overwhelming, highly concentrated capital flowing into speculative startups. That's the macro view.
Right.
But now we need to drill down into the unique financial risks being generated by the actual AI arms race, the need to build the physical infrastructure.
And this is where the story gets modern and very specific. The AI race is, fundamentally, a race for hardware.
For physical data centers, for specialized chips.
Exactly. And that scale of physical build-out requires companies to make massive upfront capital commitments. And the only way to finance that scale quickly enough to keep pace with innovation is... it's dead. And this dependence on massive borrowing is what's creating these specific financial vulnerabilities.
The sources refer to this as a requirement for front-loaded spending. We're talking hundreds of billions invested globally in constructing hyperscale data centers, acquiring tens of thousands of high-end servers,
and integrating complex cloud platforms. These are capital-intensive projects where the returns are not guaranteed tomorrow, they're only expected over years, and that's if the AI revolution continues to accelerate.
So to bridge that gap between the immediate cost and the eventual long-term revenue, firms are going on these unprecedented borrowing sprees.
They are. And the credit markets, the people who actually lend the money, are reacting with extreme caution. They're demanding a much higher risk premium.
And we can see this caution clearly in the spiking of credit default swaps, or CDS.
Right.
So think of a CDS as financial insurance. If I own a bond issued by a big tech company and I'm nervous they might default, I buy a CDS contract to protect myself. If the company defaults, the insurance pays out.
And the price of that insurance, the spread, reflects the market's perceived risk.
The fact that the CDS spreads for some large AI-focused tech companies have more than doubled in recent months, that is a screaming red flag.
It really is. It means the cost to insure against these companies defaulting has dramatically increased. Investors are signaling that they believe the financial risk associated with this infrastructure debt is soaring.
Now, wait, if we're drawing parallels, doesn't this reliance on derivatives like CDS immediately conjure up memories of the pre-2008 financial market conditions?
It does.
We know derivatives played a central role in amplifying risk then. Are we looking at a similar systemic threat?
That is the fear some analysts have articulated, and we do need to approach it carefully. The scale of the underlying assets is different. In 2008, the debt was tied to speculative, opaque mortgage products.
Right.
Here, the debt is tied to tangible, physical assets, state-of-the-art data centers, and extremely valuable hardware like H100 chips. That's a huge difference.
But the mechanism of risk amplification is similar, isn't it? The sheer speed and size of the leverage being applied raises serious systemic concerns.
It does. If interest rates rise unexpectedly, refinancing becomes difficult. If AI revenue growth slows down, that misalignment we talked about, these highly leveraged projects become financially underwater.
So the market is demanding double the protection because they see a high-growth sector running on cheap money and massive debt, and they know that combination is historically unstable.
It's a classic recipe for instability. And if the doubling of CDS spreads is the general alarm bell for the sector,
Then the specific high-stakes gamble of Oracle serves as the crucial warning sign, the canary in the coal mine.
exactly, the canary in the mine of how precarious this competition has become.
Oracle is a behemoth, but they are playing catch-up against the established hyperscalers, Amazon, Microsoft, Google.
And to compete in the AI cloud space, you can't just offer software. You have to offer the physical compute power. So Oracle is throwing hundreds of billions of dollars into expansion, including this proposed massive Stargate super data center project with OpenAI.
And this ambition comes at an extraordinary financial cost. The staggering debt associated with this rapid, massive infrastructure build is shocking. Oracle's debt-to-equity ratio has reached a colossal 500%.
500%.
Let's break that number down. For the general listener, 500% sounds massive, but what does it mean in real terms?
It means their total debt is 5 times their net assets, their equity. In corporate finance, a high debt-to-equity ratio means a company is heavily leveraged using borrowed money rather than its own capital to fuel growth.
And when you compare that 500% to competitors like Amazon, whose ratio is around, what, 50%?
Around 50, yeah. You see the extraordinary risk Oracle is taking. They are betting their entire future value on winning this AI infrastructure race, and they're using leverage as the primary engine.
And we are already seeing the cost of this aggressive competition,
Yeah.
right? It's visible in their reported losses.
We are. Recent material shows that Oracle is expecting to lose considerable sums of money on data center rentals, particularly those catering to strategic partners like OpenAI.
They've already lost money.
They've reportedly already incurred a $100 million loss in one recent quarter related to these data center arrangements.
So the need to secure those high-profile AI clients like OpenAI means they're probably offering steep discounts or favorable terms just to ensure long-term usage.
That's the game. This highly diluted margin, driven by debt-fueled expansion, it just highlights the desperation and immense financial pressure in the race to build capacity. Oracle isn't just investing, they're acting as a high-risk challenger, and they're extremely vulnerable to any hiccup in the debt markets or any slowdown in AI adoption.
Their success is critical to the wider ecosystem, but their position is financially fragile.
Very fragile.
This brings us to what I consider the most fascinating and alarming insight from the source material, the so-called infinite money loop. The closed-loop capital cycle that artificially inflates revenue across this high-stakes ecosystem. This mechanism feels ripped straight from a pre-financial crisis playbook.
It is. It's a structure designed not necessarily to serve external customer demand, but to generate internal revenue and support astronomical valuations.
Let's use the simplified three friends starting a business analogy to describe it.
Perfect. Let's walk through it slowly. We have 3 key players in this cycle.
Okay, player A is the chip giant. Let's use Nvidia. They have enormous cash reserves, high valuations.
Player B is the AI star company, like OpenAI. They need massive compute power, but they're currently generating little external revenue.
And player C is the cloud provider, the highly leveraged infrastructure builder, like Oracle, who needs to sell data center space and buy chips.
Right, so how does the loop start?
Well, it starts with the chip giant, Nvidia, Mr. A, making a strategic equity investment into the AI star company, OpenAI, Mr. B. Let's say $100 million.
Right, and that money appears on OpenAI's balance sheet.
Then what happens to that cash?
OpenAI, Mr. B, immediately pays that full $100 million, or a big chunk of it, to the cloud provider, Oracle, Mr. C, for access to expensive, high-end cloud computing services.
And this is recorded as revenue for the cloud provider.
It is. Now for the final, crucial step to close the loop.
The cloud provider, Oracle, Mr. C, then uses that exact same $100 million they just received
To purchase powerful, highly specialized chips back from the original investor, the chip giant, Nvidia, Mr. A.
The result is a magical accounting trick. The $100 million has just circulated internally and returned to the start.
But all 3 companies, Nvidia, OpenAI, and Oracle, have magically generated $100 million in revenue on their financial statements. or at least realize services that wouldn't have happened otherwise.
This closed-loop cycle strongly supports high stock prices and market valuations for everyone involved because it makes their balance sheets look far healthier and their revenue growth look stronger than if they had to rely solely on organic external customer demand.
That's the key. It's not organic.
And the fatal flaw, of course, is that the entire game relies on promises, ever-expanding credit, and the constant expansion of that internal loop.
And if any link breaks.
If the debt-laden cloud provider, Oracle, falters, or if the chip giant, Nvidia, decides to slow down its strategic investment because its own stock price is threatened,
the entire seemingly prosperous system, which is inflating income through what amounts to insider transactions, could collapse instantly. It's revenue, but it's not truly external economic activity.
Okay, so we've established that the AI financial boom is driven by this desperate race for infrastructure. Now we have to dive into the fundamental physical bottleneck underpinning all of it, the immense scarcity and demand for compute power.
And this scarcity is not just an economic driver, it is actively shaping global politics.
Compute power has fundamentally become the new gold standard for technological advancement. We're talking about the effective use of these specialized chips, GPUs, graphics processing units, which allowed AI systems to scale massively starting a little over a decade ago.
It's what allowed models to go truly deep.
So the core of the scarcity issue lies with the immense demand for state-of-the-art, or SOTA, chips.
Primarily Nvidia's H100 and A100 models, yes. The inability of supply chains to keep pace with the exponential growth in demand creates a choke point, which naturally leads to extreme market concentration, a key characteristic of the current boom.
The demand is so overwhelming that the sources include this memorable quote attributed to Elon Musk, who told a group of CEOs that GPUs are at this point considerably harder to get than drugs.
It's a striking metaphor, isn't it? But it illustrates the real-world impact of this scarcity. You cannot develop the next big AI model without guaranteed access to this hardware.
And this scarcity immediately puts two types of firms in a dominant position.
The one that designs the chips, Nvidia, and the ones that house and rent them out, the hyperscalers, AWS, Google Cloud, and Microsoft Azure. They become the gatekeepers of innovation.
And this isn't just a problem for small startups. We are seeing evidence of this bottleneck in the annual reporting of the largest tech companies in the world.
That's right. Even Microsoft, which operates its own massive Azure cloud, is now listing the availability of GPUs as a specific risk factor in its annual reporting.
Think about that. As an operational risk, Microsoft is saying their data centers rely on predictable supplies of energy, networking parts, and servers. And now the GPU supply is listed as a fundamental constraint on their ability to grow and meet market demand.
It's why Microsoft reportedly had to ration access to its hardware and even consider highly unconventional deals, like sharing AI servers with Oracle, just to mitigate the shortage.
So it's not enough to understand NVIDIA's technological dominance. We have to see how they strategically use that scarcity to control the financial ecosystem we just discussed.
It's a masterclass in strategic market influence. NVIDIA understands that the hyperscalers, Amazon, Microsoft, Google, are massive enough that they could eventually try to design their own competitive chips.
And eat into NVIDIA's business.
Right. So to mitigate this potential monopolistic competition and maintain control over distribution, NVIDIA employs calculated strategic investments.
The example of CoreWeave is perfect here.
A very clear example. Their investment of $100 million into CoreWeave, a smaller AI-focused cloud firm. This wasn't just passive funding. It was reportedly a mechanism to give CoreWeave preferential, prioritized access to the most highly sought-after H100 chips.
And that preferential access provides a huge market advantage that immediately translates into financial power.
It does. CoreWeave was able to use its allocation of GPUs, this scarce physical hardware, as collateral to raise a massive $2.3 billion in debt financing.
So the physical value and scarcity of the chips themselves acted as security for the debt.
Incredible, isn't it? And this maneuver forces the market to adjust. Since NVIDIA is directing chip flow to smaller aligned providers like CoreWeave, the large cloud players, even giants like Microsoft, are then compelled to rent compute from these smaller NVIDIA-aligned providers just to access the hardware they desperately need.
Right. Microsoft reportedly signed a deal potentially worth billions for access to CoreWeave's GPUs. NVIDIA effectively controls the flow, the pricing, and the competitive landscape.
They're creating an oligopoly that benefits its preferred partners.
And when a resource is this essential, this scarce, and this concentrated, it transcends economics. It becomes a primary point of intervention for governments.
It transforms compute into a major geopolitical lever.
The global scramble for sovereign compute capacity is intense. Governments realize that control over AI infrastructure translates directly into economic and military power.
And this realization is fueling massive government subsidies. Both the U.S. and the EU have allocated roughly $50 billion in subsidies through the respective CHIPS Acts, designed specifically to boost domestic semiconductor manufacturing and secure the supply chain.
We see the manifestation of this competition in export controls, too. The U.S. rationale behind imposing strict export controls on advanced semiconductors to geopolitical adversaries like China
is precisely to contain their technological and military advancement. By denying them access to the H100 chips and the advanced manufacturing equipment needed to produce them, the U.S. aims to maintain a technological moat.
So what does this mean for governance? Policymakers are looking at regulating industrial-scale compute, and they're drawing direct parallels to nuclear non-proliferation regimes.
The analogy is potent. Historically, non-proliferation regimes focused on controlling the key input resource, right? Uranium enrichment capacity, to govern the dangerous output, nuclear weapons.
So the idea here is similar.
Very similar. Controlling the input resource, industrial-scale compute capacity, should be the most effective way to govern the output-powerful AI models that could pose national security risks. This involves tracking who owns vast clusters of GPUs, monitoring their utilization, and imposing strict export controls.
But if we accept that analogy, we have to acknowledge the massive limitation that undermines it. The sources highlight a crucial difference: the release of model weights.
This is the Achilles heel of the strategy. Model weights are the specific numerical parameters that define a trained AI model. They are the non-rivalrous, easily transferred information.
Training a powerful foundational model requires vast industrial-scale compute power the resource governments are trying to control.
However, running a trained model, a process called inference, requires far less computing power.
And the threat is clear. If a bad actor gets access to the fully trained model weights, they don't need billions of dollars in GPU clusters to run it. They can use relatively moderate expertise and commercial hardware to perform inference,
effectively bypassing the entire geopolitical compute control regime. The information, once it's public, cannot be contained in the same way that physical uranium enrichment facilities can be tracked and controlled.
Okay. We have dissected the risks, the debt, the scarcity, the geopolitical battleground. But to fully understand why companies are taking on this massive debt and exposure, we have to ground the conversation in the measurable, tangible impact AI is already delivering across industries.
Right. The scale of the investment is only justifiable if the productivity gains are real and massive.
And the shift from theoretical possibility to tangible reality has happened much faster than many predicted. We have concrete data demonstrating where generative AI is creating immediate, measurable value,
often in tasks that are historically time-consuming, expensive, and labor-intensive. Look at customer service, a notorious drag on resources.
Okay.
The Taiwanese electric vehicle brand, LUXGN, deployed an AI chatbot that reduced the workload of human customer service agents by a significant 30%.
30%. And we also see consulting firms benefiting. Deloitte's Care Finder agent reduced the time for an agent to look up in-network medical providers from 5 to 8 minutes.
Down to less than a minute. That's a 500% efficiency gain on a critical, repeatable task.
In coding and development, the adoption rate is now dominant. 72% of software engineers report using generative AI.
And nearly half utilize it daily. The productivity gains are not marginal. They are huge. Tools like GitHub Copilot have demonstrated a 56% increase in speed for programming tasks.
There's another fascinating data point from the startup Stacks, which reported that 10 to 15% of its production code is now generated by AI tools like Gemini Code Assist.
The efficiency gains extend even into highly regulated, high-stakes sectors like finance. Banco Covalto in Mexico reduced its credit approval response times by more than 90%. By transforming its operations with Gen AI.
90%. And in the mortgage industry, United Wholesale Mortgage more than doubled underwriter productivity in just 9 months.
These are not minor efficiency bumps. These are structural business transformations that justify massive capital investment.
And this augmentation, it leads to the crucial discussion on labor. If productivity doubles, does the firm need half the staff?
Or can they take on twice the volume? The sources frame the discussion less as replacement and more as a shift in required skills and augmentation.
So current estimates show that around 42% of current jobs are potentially exposed to generative AI automation, weighted by earnings potential.
And the data supports the idea of stagnation, if not outright decline, in certain areas. Job growth has specifically stagnated in occupations with the highest automation potential, those with 90 to 99% exposure.
So that suggests that while we may not see mass layoffs, the capital investment is shifting dramatically away from hiring labor in highly automatable areas and toward investing in AI services.
Exactly.
Now, beyond pure output productivity, AI is proving equally transformative in the esoteric but vital area of risk management.
Specifically, non-financial risks, or NFR. These include operational, reputational, legal, and compliance risks that can destroy a firm's value just as quickly as a financial crisis.
And the challenge with NFR has always been its complexity. These risks are interconnected, often emerging from vast amounts of both structured data, like transaction logs, and unstructured data,
like customer complaints, emails, social media sentiment. Traditional human-led systems are often too slow and subjective to capture emerging risks in a timely manner.
This is where AI excels. It increases both the effectiveness and the efficiency of NFR management, driving better compliance, standardization, and, crucially, improving the customer experience by spotting systemic failures instantly.
A perfect, high-value example of this transformation is in complaint handling within financial institutions. LLM-powered solutions now provide three vital functions simultaneously.
What are they?
Real-time call transcription, sentiment analysis, and instant flagging of potential compliance violations during the call itself.
So imagine a customer calling in frustration. The LLM is listening, transcribing the call in real time, analyzing the sentiment, "This is an angry customer," and immediately alerting the agent if specific prohibited phrases or promises are made.
Ensuring compliance in the moment. It acts as an immediate quality assurance checklist for the agent.
But the deep insight comes from the post-interaction analytics.
That's where the magic is. The AI doesn't just log the complaint, it extracts granular information to perform root cause analysis across thousands of interactions. This leads to truly actionable business intelligence.
For instance, the analysis of a complaint dashboard could show that out of all complaints analyzed, 54% of the root causes were classified as software updates.
Now, 30% were attributed to new policy introduction.
That level of detail is transformative. Before AI, you just know you had a lot of complaints. Now you know exactly which specific software update or which new policy is causing 84% of your systemic failure.
Allowing you to mitigate at the source, rather than just reacting to individual complaints. This ability to transform risk data into operational insight is why companies are willing to take on massive debt to access this compute power.
What an incredible contrast we've explored today. We've established that while the AI boom is supported by strong profitability in its market leaders and is not as euphoric as the dot-com era.
In terms of overall valuation multiples, at least.
Right. It harbors entirely new risks.
These unique risks, unprecedented debt levels in the infrastructure layer, and these closed-loop circular funding mechanisms that inflate revenues are highly concentrated around the physical assets required for AI.
And this entire system is driven by the extreme scarcity and geopolitical importance of high-end compute. This scarcity has created a market structure where control of the hardware dictates the flow of capital and forces nations to reevaluate their technological sovereignty.
The ultimate challenge now is the great balancing act.
Balancing the immense financial risk being taken on by highly leveraged companies like Oracle and CoreWeave with the incredible, measurable, and tangible productivity benefits AI is already delivering across essential sectors.
From doubling underwriter productivity to fundamentally transforming non-financial risk management.
We keep circling back to the sheer cost of this revolution. We learned that analysts estimate AI firms will need a staggering $2 trillion in annual revenue by 2030 just to meet the projected global compute demands.
A figure that is exponentially higher than the industry's current revenues.
So, if those proven productivity gains, the real value being created in coding efficiency, financial approvals, and customer service optimization, if they don't translate into enough organic external revenue growth quickly enough to meet that $2 trillion infrastructure cost.
What happens to the highly leveraged firms that have bet their entire corporate futures on building that infrastructure capacity?
That is the inflection point where the real value meets the real risk.
And until the next deep dive, we encourage you to keep questioning the narrative and looking beyond the headlines.